Okay, for this video, I wanted to go over with you the IRS's tax withholding estimator on their webpage. So who would need to use this and why? When you're an employee and your employer asks you every year to fill out that W-4, right? So W-4 might ring a bell. Basically, that form is used by your employer to figure out how much withholding tax, federal withholding tax, should be taken out of your paycheck every week, 2 weeks, every month, depending how often you are paid, in order to keep in line with the federal tax rules and regulations surrounding employee tax withholdings. So this estimator is provided for you as a taxpayer to figure out, okay, based on how much money I'm making, based on how much money might be coming out of my paycheck, based on my other income and expenses and deductions that I'll take on my 1040, what do I need to put down on my W-4 to make sure that the withholding tax is as close as possible to the amount of taxes that I should be paying at the end of the year. The idea here is we're trying to get it to a point where you don't have to write a check. You might not have to owe additional money at the end of the year, and you're not getting a massive refund either. Because remember, if you get a big refund check, that basically means you overpaid the government during the year, which is not ideal, right? Because they held on to your money, you didn't get to use it. And then on the flip side, if you don't have enough paid in, not only do you owe them money when you file your Form 1040 tax return, but the IRS likes to charge you underpayment interest and penalties if you don't have enough paid in. So the withholding estimator, a very good tool to try to figure out what ultimately you're going to owe and how to adjust your withholding up or down to meet your circumstances. So in this video, we're going to go through a very simple example. Let's just use an example where we have an individual that's maybe in his mid-20s. He works one job full-time at an accounting firm. And so he's going to go through this estimator to try to figure out, okay, is my withholding tax appropriate? Do I need more? Do I need less? So if you go to the IRS website, in the Individuals tab, they have a tax withholding estimator. You could just go to Google and Google this, IRS tax withholding estimator, and it should come up. So this is the initial landing page. And then in the middle here, the blue box, use the tax withholding estimator. Go ahead and click on that. Okay, then we go ahead and wait for the page to load up here. Then we can start answering the questions. So the very first question that comes up, information about you, particularly your filing status. Okay, filing status is very, very important to get correct because this is the initial driver for how your return is going to be computed, what tax rates you're going to pay, what your standard deduction might be. So what filing status will you use for your tax return? And they're talking about the tax return that you will be filing at the end of this year. So it's now May 2022. I'm filling this thing out now. I'm updating my W-4 now. What they're asking is, what will my filing status be for the 2022 tax year? So that's this year. So when April 2023 comes around and I'm filing my 2022 tax return, what filing status am I using? So single filing status, basically that just means that you're not married, right? So you're a single filer if you were unmarried at the end of the year. And what's also important to note is you're single and you don't have any qualifying children that could be dependents. And the reason why that distinction is important, because if you are unmarried but you have qualifying children as dependents, instead of choosing single filing status, you're most likely going to be better off using the head of household filing status. Head of household effectively means you're single and you have children, right? The reason why HOH is a much better filing status because you get a larger standard deduction than the single filing status, and the tax rates within your marginal brackets are generally lower. So you've got lower tax rates, you've got a greater standard deduction. So head of household, certainly better for most single parents that have qualifying children as dependents. Now, what about the married sections? Well, married filing joint means that you are married at the end of the year and you and your spouse agree to file a joint tax return. The agree part there is really important because there are a lot of married couples where they cannot agree to file a joint return. And so if both spouses don't consent to filing a joint return, you're still married, but now you have to do a married filing separate return. Now, even if you are in agreement about what to do, a lot of times the married filing separate can work as an overall tax saving strategy, right? So you initially prepare a married filing joint return. But then you just decide that, well, after we do everything and split the return, we see that we actually save money by filing separately. And you're certainly allowed to do that. In this case, again, we're just going to have a single filing taxpayer, so we're going to select that box right there. Now, the second question that pops up, do you or will you have a job that is going to be regularly withholding federal taxes from your paychecks? So if you're an employee and you work for a U.S. employer, this is going to be you, right? Your employer is obliged to consistently take federal withholding tax out of your paycheck. Now, the amount might go up or down. Particularly there's a change from the very first paycheck of the year to the first few paychecks in. So the amount might change, but the point is that they are regularly going to be taking that money out of your paycheck as they are required to do under U.S. federal law. Okay, so we're going to go yes. And then here it asks us, select any additional elements here that might apply. In our case, we don't have any of these, right? So our taxpayer is in his 20s, so he's under 65. He is not blind, and because he's in his 20s, he's not living at home anymore. He supports himself. He's not going to be claimed as a dependent on somebody else's return. Okay, so we're going to leave all those blank and then click next. Now, income and withholding section. So you can see up here how we progress, right? So we just got through part 1, then we have part 2, 3, 4, 5, and 6 is the result. So part 2 here, income withholding. Enter the information for each job that you're going to have income for the year, okay? Now, obviously, you can't predict the future. So, if you have a job now, but you might lose it, or you plan on quitting and then getting another job, but you're still unsure what your pay might be, that's okay. When you fill this thing out, obviously, if you have all that information in front of you, then use it. But most taxpayers are really just filling this out under the pretense that they're going to keep the same job throughout the year, so not much is going to change. And that's going to be our example here. So we have an individual, he's on a salary, and so when it further asks, what describes, select what best describes when you earn income from this job. So they're asking, is this a seasonal job, or are you going to have this year round? What's that outlook look like? And in our case here, he's going to have it all year, right? I currently hold this job. You can see how they definitely drill down on some, more options for you, right? So I have this job, but only a portion of the year, had this job early in the year, it's a Q&A, so go ahead and fill everything out as it asks and just try to be as accurate as possible. Our example here, he's going to be paid once a month. And the most recent pay stub he got, so we're in the middle of May right now, so let's assume that he got paid out April 30th, right? So if we go down, April 30th was the most recent pay period where he got paid, and so that's the stub that he has in front of us. Now, let's say, for our argument's sake, that our employee is on, let's say he's on $48,000 a year, right? So $4,000 a month times 12 is $48,000 a year as a salary. So the wages or salary per pay period is going to be $4,000, and then the wages or salary paid year to date. Well, he did January, February, March, and April. So 4 months is going to be $16K, right? Throw in a $16,000, and based on information provided, it looks like your expected annual income is going to be $48,000. Okay, yep, $48,000. That makes sense. Do some mental math in our head here. Try to figure out what it is we're going to owe. So enter federal taxes paid per pay period. So let's say $4,000 every month is his gross pay, and then the amount of federal income tax that is coming out each month is $1,000. So if we enter $1,000 here, and then the federal taxes paid year to date, remember, January, February, March, and April. So he's paid in $4,000 in federal income taxes. Okay. Now, then it further asks, select any of these that might apply, right? Do you contribute to a 401k? So 401k plans are retirement plans set up by your employer. The reason why those are important to know about in this section, because when you make contributions to a 401k plan, the amount you contribute each pay period and collectively over the whole period is a pre-tax deduction. So in other words, it comes off the top of your gross pay. You don't have to report that gross pay amount on your 1040. You report the amount after the reduction for their 401k contributions. Okay? And then we also have health savings accounts plans there, flex savings accounts. None of this applies. Bonus, this is important because as we've indicated up here, we're saying that our salary is going to be $48K a year, but what if you get a large bonus at the end of the year? Well, that's obviously going to increase your gross income. Let's just assume, for argument's sake, he's not going to get any. That's probably why he's going to quit his job, go somewhere else where they're nicer to him. Let's select, none here. So we're going to do none of the above, none of these unique types of situations here. And then it asks us, do you have any other sources of income, or have you made any other estimated tax payments? Now, why do they want to know this? If you have income from other sources and it's not being subjected to withholding, you can update the withholding with your employer to cover whatever you think that estimated tax is going to be, right? So let's say he did have some investment income of 10 grand, right? So if he makes $10,000 in dividends and interest, well, the broker isn't going to withhold tax on that, right? Generally speaking, they don't. They just deposit it into your account and they report it to the IRS. So what our taxpayer could do here is he could report the investment income, and then they would estimate the amount of tax owed, and that additional withholding tax would come out of his employee salary, his paychecks. You can do that, right, if you want to make sure that you're having enough paid in throughout the year, but generally most taxpayers don't do this, honestly. If you have sizable investment income, if you have rental properties, then you're much better suited off, in my opinion, to just calculate what you think you're going to owe and make estimated payments separately. Don't give that information to your employer and have them adjust your withholding. Just work with your CPA, work with your tax advisor, figure out what the additional taxes owed are, and then make a quarterly payment. Okay, so in this example, we're going to keep it simple. I don't have any other sources of income, right? Nor did I make any estimated tax payments. Now we get into the adjustments to the income. Okay, adjustments to income. What are they after here? Adjustments to income are any reductions in your income in arriving at adjusted gross income. Okay, so for example, student loan interest. If you make payments on your loans, student loan interest, you are allowed a student loan interest deduction of up to $2,500 worth of interest. And that deduction is a reduction to your gross in arriving at your adjusted gross income. Okay, other things that are relevant here. Deductions for contributions to an IRA. So if you make contributions to a traditional IRA and your income is within certain thresholds, right, so you're not phased out, the amount of money you put in a traditional IRA is an above the line deduction, okay? In contrast, Roth IRA contributions, you don't get a tax deduction. But with traditional IRAs, yeah, you might, depending on what your overall income is, right? Because again, traditional IRA contributions, the amount that you can deduct is phased out up until a point where it's almost phased out completely, depending on how much money you make. So in this example, again, we're gonna make an assumption that nothing really unique is going on here, so we're gonna leave all that blank. And so it's telling us that the adjustments entered are going to be 0, okay? Now, click through the next here. Now, deductions from income. Okay, so after we did the adjustments from the prior page, now we have our adjusted gross income. Now we've got our AGI. So then what do we do next? We decide whether we're taking the standard deduction or an itemized tax deductions. The standard deduction for 2022 is going to be $12,950 for a single filing taxpayer. If this individual knows or has reason to believe that their itemized deductions are going to be higher, then they might itemize their deductions, okay? And then they can list what types of itemized deductions they have. Charitable contributions, medical expenses over the threshold, casualty losses, right? If you own your own home, right, you'll have real estate taxes, you have mortgage interest, all these types of things that might be deductible on Schedule A of your Form 1040. In this case, we don't have any itemized deductions, so we're just going to take the standard deduction for the year. But again, if you have itemized deductions, please feel free to check itemized deductions and input as many as you think you'll have, and that'll help appropriately update your W-4 to reflect that information that's likely going to happen at the end of the year. Okay, so click through the next. Now we jump into tax credits. Okay, tax credits. There are a ton of different tax credits out there. There's federal tax credits, and then there's state tax credits. The most popular federal tax credits we see are certainly child and dependent care, right? So if you have children, and just the fact that you have children and they're 17 years old or under means you might be eligible for the child tax credit. The dependent care credit is if you pay for dependent care, so you pay for daycare, right? If you have a child that needs to go to daycare because either yourself or your spouse or both of you need to go to work, you might be able to get a federal tax credit for amounts paid to the child care provider. Foreign tax credits, if you have an investment account, so let's say you got a Robinhood brokerage account and you're investing in some foreign ETFs or things that might have some some foreign taxes withheld. You might have a foreign tax credit. Educational is also a popular one, right? If you're in college, right? So if you're enrolled in a higher learning educational institution, however they refer to it, it's basically a 4-year university degree. If you're pursuing a degree, you can get an educational credit, so things like the lifetime learning tax credit or the American Opportunity Tax Credit. Energy efficient vehicles is a big one now, right? So Tesla, their EV credits have kind of phased out because they've been around too long, but if you have a qualified plug-in electric vehicle, you might get a credit. So all the other big names out there that are producing these now, Audi, BMW, the list goes on and on, right? So always, if you have a qualified plug-in electric vehicle, you might get an energy efficient vehicle tax credit. You can enter that information here. Now in our example, we're going to assume, again, nothing really unique here, right? We have a single filing taxpayer. He doesn't have any investment income. He doesn't have any kids, and he's already out of school, right? So a lot of these credits just don't apply. So we're going to click through next. And it's going to load up the final page here, the result page. Okay, so here's how to read this. The results, right? So if you do not change your withholding, you are likely to get a tax refund, okay? So what happened here? Well, what this is telling us is that based on the numbers we inputted, so remember our salary was $48,000 for the year, and we were saying that we had $1,000 in federal tax withholding coming out of our paycheck every single month. Okay, so there's the $12,000 in expected withholding that's going to come out of our paychecks, and then the anticipated tax that we're going to owe is going to be $4,000. So what they are doing there is they're kind of computing for us. Well, if I go ahead and prepare my 1040, let's say I fast forward 8 months to next year, and I'm preparing my 1040. And what they think is, based on the numbers I provided, the amount of tax that I would actually owe is only going to be $4,000. But I had $12,000 in withholding that was coming out of my paycheck. So my refund is going to be the difference, right? How much did I have paid in versus what do I actually owe? And then that's the amount of tax that I am going to get back, okay? Now, what's also important to remember here is to review all the information down here to make sure it's accurate, right? So they put all this information down here, make sure those numbers are correct. Obviously, if you mess something up, it's okay to click through all the way to the end like we are here, and you can just edit each individual section. So you can go back and kind of play with the numbers if you want, and then keep flipping back and forth. Now in this one, it didn't offer us any suggestions on how to adjust our refund. Adjust our withholding. And this is an unfortunate reality for a lot of taxpayers. A lot of taxpayers are